In this video, I'm going to share the 4 steps I use to help small business owners plan a successful transition out of their business into the next phase of their life. Whether that be retirement, whether that be spending more time with family, traveling, or cutting back to do part-time consulting to keep busy. This will be the roadmap to help you break free from the daily grind and get off the treadmill of running your business so you can enjoy your golden years and have the freedom to do what you love to do. And by the end of the video, I will take you behind the scenes directly into my financial planning software where we'll dissect a real life case study so you'll know exactly how to apply these principles to your own journey. So let's dive into step 1 of our 4-step framework, which is to fully understand your current financial situation. Meaning to take a step back and zoom out on your financial picture to get a holistic perspective. We need to understand what assets you have, which could include investment accounts, bank accounts, your primary residence, real estate, and most importantly, the value of your business, which for many owners, in my experience, will make up the majority of your net worth. Now, in addition to listing out your assets, we also need your liabilities. So that's any debts that you owe, like a mortgage on your house, debt on any real estate, credit cards, student loans, auto loans. And so once you list out all of your assets and liabilities, if you subtract assets minus liabilities, you now know your overall net worth and have a holistic perspective on your own financial situation. Step 2 of the 4-step framework is to determine the cost of retirement. This is how much money you will need when you transition out of your business to support your desired lifestyle in retirement. The cost to fund this phase of your life will be affected by many factors, and I want to mention 3 of the most significant ones, with the first one being your monthly living expenses. How much you need in order to support your desired lifestyle is a major factor into the cost of retirement. The higher your expenses and the more extravagant your lifestyle you want, the larger bucket of money you'll need to have. Now, to help determine your future expenses, a common rule of thumb is it will be somewhere between 70 and 100% of your annual earned income. So if you're making $300,000 a year between salary and distributions from your business, your estimated living expenses would be around $210,000 to $300,000 per year, or $17,500 a month to $25,000 a month. Keep in mind, of course, this number can significantly vary and be lower depending on where you live in your lifestyle. The next factor that affects the cost of your retirement is your age when you want to retire. Because when you stop working full-time, you'll start pulling money from your investment accounts to replace your income. So making sure you have enough assets saved up to pay yourself an income stream for the rest of your life will be critical. Retiring too early and not having enough money to support yourself, or retiring and not preparing for an unexpected life event, can force many to go back to work. Look at your assets and consider your potential income sources. Income sources can include investment accounts, IRAs, Social Security, pensions, selling your business, or part-time consulting, which I often see a lot of owners doing on a part-time basis to supplement their income. And the last significant factor that affects the cost of retirement is your life expectancy. So how long you live in retirement. The longer you live in retirement, the more money you'll need to support yourself to avoid running out of money. So if you are healthy and have a ton of vitality, you can stop working at 65 and potentially live another 35, 40 years. If you look, here's a chart on life expectancy probabilities for men and women. And if you look here, for a man or woman who is a non-smoker and in excellent health, women have a 54% chance of reaching age 90. Men have a 43% chance to live to age 90. This is why many people, especially entrepreneurs, never fully retire. They become a consultant, start another business, or end up doing something that keeps them busy because we usually can't sit still. So a quick review. The 3 most significant factors that determine the cost of your retirement include your monthly living expenses in retirement, the age when you retire, and your life expectancy in retirement. Step 3 of the 4-step framework is to determine if there is an income gap between the projected income you can potentially get from your current assets, which we put together in step 1, compared to the cost of your retirement, what we discussed in step 2. So given your current financial situation, we are trying to figure out, are we on track? And if you're not on track, step 4 of the framework is to make the necessary adjustments to your plan, which can include delaying your retirement date by 3 years, save and invest more on an annual basis, cut expenses before or after retirement, or for entrepreneurs and business owners, we build your business to the point where it's attractive enough to sell and contribute the proceeds to help fund your retirement bucket. Now, we use planning software to figure this out because there are so many variables that go into it, like your current assets, debts, rate of return, how much you are saving, inflation, taxes, and of course your personal goals on what you want to do in the next chapter of your life. It's a lot of stuff. Think of these variables as levers, and they can be adjusted up or down over time to get you where you want to be. And so now I want to take you behind the scenes into my planning software and show you a real case study on how this works. Okay, so here we are in the planning software, and this is going to be a sample case study with a sample client named Frank and Joanna, and we are first going to look at their net worth summary. So if you remember back in step 1 of the framework, listing out our assets and liabilities so we can get an understanding of our complete financial picture. And so that's what this is here. We have Frank and Joanna, both of their individual assets, and then we have their joint assets, which is actually broken down if you look below here, the business, and then they have a joint investment account. So the business interest itself is worth $2.2 million, so almost 60% of their entire net worth, followed by real estate, qualified retirement, and taxable investments, and a little bit of cash there. So again, when you list these out and you total your assets and subtract from your liabilities, which in this case, the only liability they have is the mortgage on their home, you then get your total net worth. Again, so you can get that holistic perspective on your entire financial situation. Now, if we jump over to their actual assets and portfolio. So in this scenario, we have Frank and Joanna at age 56 and 55 planning to retire in the years 2030 and 2031. So this is just showing them running out of money when they turn 69 and 68. But on the left-hand side, these are the variables or the different levers that we can adjust up and down or turn on and off to tweak their plan and position them for long-term success. So let's say, for example, we delay retirement as opposed to retiring at 63. We delay retirement 2 years to age 65. And look what that did. That increased their value by $670,000 and added an additional 6 years to their plan. Now, let's say Frank wanted to do part-time consulting in retirement, and we did not want to delay our retirement, so we turned that off. That added 3 years to their plan, so that's obviously not going to be enough. Let's say we increase Frank's annual savings into his 401k until he retires. That added, again, that pushed it out to 6 years. So let's couple that with, let's say we decrease retirement expenses, okay? This is really going to move the needle. Look at that. We added $1.3 million to the overall plan, and they're obviously going to be in great shape if they were to decrease expenses in retirement. Let's just say we didn't want to consult in retirement. We can't increase annual savings. We just want to decrease. So look at that. That pushed everything back to 14 years, okay? And that's just decreasing retirement expenses. So here's where the magic happens if you're a business owner and you have a business that is attractive and can potentially be sold. Let's say you were not able to decrease retirement expenses, or maybe you didn't want to sacrifice your lifestyle in retirement. Let's also say that you can't take working anymore. You want to get out of your business. You do not want to delay your retirement age. Let's say even you don't want to consult and you did not want to increase your annual savings. If you just were able to sell your business, which again, in this scenario is worth $2.2 million, after taxes, okay, there's going to be capital gains taxes, there's transaction costs, there's at least going to be up to 8 to 10% in fees with that. After all of that is paid, the net proceeds of this is an absolute game changer and creates generational wealth. That adds almost $3 million to the overall plan. So this is why when we talk about retirement for business owners, the opportunity to create generational wealth is crazy. If you have a valuable business. Now, if you do not want to sell your business, there are obviously other levers here that you can turn on and turn off where you can still have a successful retirement. So if you don't want to sell your business or you slowly want to transition it to your children, you can still make that happen. It just depends on what you want to do and what your goals are. Now, by the way, I wanted to ask you, is this helpful to see an actual case study? I know many of these videos is just me talking and I put some numbers on the side of the screen, but this is actually encapsulating what this looks like comprehensively. If this is helpful, let me know in the comments. Say, Tom, yes, please do more of that. Tom, show me something that's related to taxes or spending or whatever it might be. Or say, Tom, this isn't helpful, and go back to what you were doing before. Either way, the point I want to get across with this is not that your plan is going to look exactly like Frank and Joanna's plan. The point I wanted to make is sometimes retirement and transitioning out of your business seems so daunting, and you look at the numbers and say, we're nowhere close. But making small changes with regards to how long you work, or working part-time, or making little cuts to expenses might have a profound impact. It's important that you do the planning, though, because there's not a one-size-fits-all formula. It's about understanding where do things currently stand, and then what are the little levers that we can pull and make the plan a reality or to improve the odds of success. So I hope this is helpful. Again, I'm the founder of Beyond Your Exit Wealth Management, and if you're interested in learning more about how we help business owners navigate through a business transition, be sure to check us out at beyondyourexitwm.com.